Credit cards are the most powerful tools in your financial toolkit, or they can be the most dangerous. It all depends on how you use them. So today, we're going to bust 3 major myths about credit cards that could be costing you thousands of dollars. And if you've ever thought that paying the minimum is good enough, that carrying a balance helps your credit, or that credit cards are just plain evil, you're going to need to stick around to the end of this video. So without further ado, let's get right into it. Okay, so let's say your credit card statement says you need to pay $25 this month. Now it sounds manageable, but here's the truth. Paying the minimum is like paying rent on your debt. You're not owning it, you're not eliminating it, you're simply keeping it alive. You see, the minimum payment mostly goes to interest, not the amount borrowed. This means your balance hardly budges. And while you avoid late fees, you still end up trapped in a long, expensive cycle. So let's say you owe $3,000 at an interest rate of 22%. If you only pay the minimum, which is about $75 a month, it could take you over 15 years to pay it off, and you'll end up paying more than $6,000 total. That's double what you borrowed. So don't confuse minimum with safe. It's only the minimum payment you make to keep your account in good standing, and not to keep you financially free. So the smart move is to always try to pay off your balance in full. And if you can't, pay as much above the minimum as possible. Okay, so this myth is one of the most frustrating because so many people repeat it like gospel. Leave a small balance on your credit card because it helps your credit score. Not true. Carrying a balance increases your credit utilization, which is how much of your available credit you're using. And high utilization is one of the fastest ways to lower your credit score. So let's say you have a credit limit of $1,000 and you carry a balance of $700. That right there is a 70% utilization rate, which is way too high. You want to stay under 30% and ideally under 10%. So instead of helping your score, carrying a balance is like walking around with an unnecessary weight. You don't need debt to prove you can manage credit. What you need to show is that you can use it responsibly. So the smart move is to use your credit card, but pay it off in full before the due date. That's how you build a strong credit profile. Okay, so some financial gurus will tell you to cut up your credit cards, never use them, and avoid credit completely. But that's like saying you shouldn't drive a car because you might crash. Listen very closely. Credit cards aren't bad. Bad habits are. But when used the right way, credit cards can help build your credit history. They also offer rewards like cash back, miles, and hotel points. They provide purchase protection and fraud coverage that debit cards often don't. And they also serve as backup in case of emergencies. So again, credit cards only become dangerous when we use them to live above our means. But when used intentionally, they're one of the best ways to build a strong financial foundation. So the smart move is to choose 1 or 2 cards that match your lifestyle. Use them for regular expenses and pay the full balance each month. So let's recap what we've learned today. Myth number 1, paying the minimum just keeps the lights on. It doesn't pay off your debt. Myth number 2, carrying a balance lowers your credit score. It doesn't raise it. And myth number 3, credit cards aren't evil. Misuse is. But when used wisely, they can build your credit, save you money, and even reward you. Now, if you found this helpful, hit the like button and subscribe to this channel for more finance topics. And if you're ready to take control of your finances, hit the first link in the description of this video. Remember, it's not about avoiding credit. It's about mastering it. And we here at Smart Financial Blueprint can help you achieve that. But in closing, my name is Amner Gellin Jr., and as always, stay smart.